Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And on today's show, Gabi and I talk about the real cost of interest rates and inflation. Now, it's a cool episode because what we're actually trying to do in this episode is encourage you to think a little differently around what is happening in the current environment with the context of inflation and interest rates. We talk about real interest rates and the real cost of capital. We talk about how to think about deploying capital in the current environment, what inflation is doing to your cash, and effectively how you can start to really think about things like total returns and try and take your attention away from whatever might be happening on a pure cash flow basis in your portfolio and all of that kind of stuff. So it's a really critical environment for property investors. It's very easy for people to get waylaid in their thought thanks to a lot of media negativity and loads of inputs from all over the place. So I encourage you to check this episode out. And if you think it's beneficial, helpful, if you think it gives you a new perspective on how to navigate this kind of environment, then I encourage you to share this with a friend, family member, or loved one. We really value that. The podcast has been growing a lot lately, and it's all thanks to you. So I just want to say thank you so much for helping us to get the message out there. But I would love it, and I would ask a massive favor from you right now, and that is to find someone who doesn't yet know about the Investor Lab and give them this episode or another episode if you don't like this episode, which is totally fine, but you might like another episode. Send them that one and help them to get involved too, because our mission is really to help empower all of you guys who are listening to this podcast to become more successful investors and to be able to live a life of freedom, choice, and abundance. That is our goal. And I hope that we are delivering on that. And if you've got any suggestions, questions, or anything you'd like to submit to us here at the podcast, send it to TIL, that's TIL at dashdot.com.au. And without any further ado, let's get stuck right into the episode. I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me today is my co-host and compadre, Gabi. How are you?
Woot, woot. Hello. I'm good. How are you going?
Very well, thank you.
Wonderful.
Got the day off to a good start. Woke up, had a little bit of anxiety, so I thought I'd have a coffee because coffee usually solves anxiety. That's what I've heard. Yeah, totally. Yep. Went to the gym, pumped some iron, went Arnie style, and then I went and had a sauna and an ice bath. I got to say, such a good way. Yeah, such a good way to kind of get your parasympathetic nervous system back in line and all of that kind of stuff. I had a bunch of ashwagandha as well. So I dosed up on ashwagandha and then went and jumped
with your coffee.
Yeah. Caffeine plus ashwagandha. It's good. It's it's a bit of a roller coaster ride.
The goose mix.
Get jacked and calm at the same time. But no, it's awesome. I highly recommend it. It's obviously not something everyone can do or has the capability or the facilities or whatever to be able to do. But if you've got the opportunity or if you've got the inclination, I reckon jumping in an ice bath, as regularly as you can is so good because it really helps train the vagus nerve and kind of brings you, it really centers you again. And yeah, so I'm feeling good.
Love it. Nervous system chat first up. It's good. Well, I didn't quite have that exciting of a morning today. I just went for a little walk, but it was nice. Went for a walk on my own, had a little coffee on my own.
Nice.
Good. Yeah.
Nice. And for those of you listening at home, you're probably going to notice we might have slightly different audio visual quality than we usually do on the podcast today. We've changed offices, we've moved locations, all of that kind of stuff. And so we're still kind of navigating the setup. So in advance, I hope that you can forgive us for any kind of echoes that you might be hearing and stuff, and we'll work to remedy that for future episodes.
Goose is very concerned about the audio quality, so yes, apologies in advance.
Yeah, well, I care about it, right? Because I listen I listen to podcasts on headphones, cruise around, and every now and then you listen to a podcast that's really poor audio quality, and it's I don't care how good the content is, I'm out of here, you know, and I know that we're going to be talking about some pretty interesting stuff today, and hopefully the audio quality is good enough that you want to stick around because I think it's some really cool stuff that we want to get into today.
Cool.
So what are we going to talk
around.
about? What are we going to talk about then, Gabi?
Well, hot topic at the moment, right? If you're at all invested or interested in property, the words interest rates seem to be kind of haunting everyone these days. And even yesterday, RBA, another cash rate hike just yesterday. So people are concerned about interest rates. They're concerned about the impact on cash flow, not just for investors, but obviously anyone who has a mortgage that has some kind of interest rate that they repay.
Yeah.
Monthly repayments are going up. So people are concerned at like, what point is that going to stop? How is that impacting me? And so we kind of want to pull that apart in the sense of like how to think about it differently, and comparing it with inflation, which is ultimately like the reason that the rates are going up is to try and combat inflation. So we want to pull apart like, what does that actually mean and how to think about it a little bit differently.
Yeah, 100%. And so I think what's really interesting actually is the amount that interest rates are going up, because if you had asked me a couple of months ago, and for anyone who listens to the podcast regularly, you probably have heard my forecast on where I think the cash rate and interest rates are going to go. I think they're going to go higher. So I'll be the first person to call out the fact that, our perspective, when I say our, I mean the global, the national we, including probably the RBA and anybody else in finance or whatever, the interest rates are going higher than I believe that the interest rates are going to go higher than we would have thought weeks or even months ago. And I think there's a really good reason for that, right? But I think that what can happen is that people can get scared, concerned, worried, all of that kind of stuff. And they just don't know, like, is it even a good time to invest? Or how should I be thinking about this? How do I navigate this kind of environment? Or how do I, and so it's really important that we kind of dig into what's going on, but also how to think about it in a slightly different way. And let's be super real, right? So as interest rates go up, it negatively impacts cash flow, right? There's no two ways about it, right? And transparently, all of our mortgages are on variable rates because we like the flexibility. And for the first time ever, our portfolio has gone slightly cash flow negative. Now, all good. Like, are we concerned? No, that's fine. Partly because of our perspectives on growth, the transience of this cycle, all of these other kind of factors. And so for us, it's like, it's all good. But sometimes that kind of the context around that kind of shift in a portfolio can be really disarming. And it's so I think I'd love to do a couple of episodes kind of digging into like how to think about all of this kind of stuff and how to navigate it, because it's a natural concern for people. And what can end up happening is people can end up making bad decisions about how to navigate a high interest rate environment. But that's a topic for another podcast, because what I think is really interesting and what's really important to that people kind of forget, right? Or I think, or maybe don't really fully, conceptually understand. It's like, why are interest rates going up? Well, because inflation's going up. Okay, well, yeah, okay, but
what does that mean?
Why?
How does that work?
Who cares? Like, what? My coffee's more expensive, so you're making me pay more on my mortgage? Like what? That doesn't make sense. And it's kind of it's sort of not that simple, right? So, well, in a sense, right? And we've kind of talked about this in previous episodes. We won't hang here for too long, but basically, because of supply chain breakdowns due to COVID, then China's lockdowns. China's gone back into another. There was 4 cases, Gabi, 4 cases of COVID in Wuhan the other day, and they've gone into like total complete shutdown again. It's wild. They've still got this COVID zero kind of mentality, which I think the rest of the world has shown is probably not the best approach economically and all of that kind of stuff. But the reality of the situation is China is such a major influence on the global economy through trade and export and manufacturing and all of these other kind of factors that when they shut down, it actually shuts down massive parts of the rest of the world, right?
Yeah.
And so between that and then also supply chain issues coming out of the war in Ukraine and Russia and all of these other kind of factors, right? We have this situation where loads of money got pumped into the economy during COVID as stimulus to try and, keep the economy alive, keep things firing, encourage people to spend money, doing all that kind of stuff. Now people are spending money, right? But we can't get the goods and services to keep up with the demand, which means that prices go up, right? And so one of the ways to cool the economy and to cool spending is to nominally increase the cost of capital, and which impacts the cost of living, which then causes spending to go down. And and we're actually trying to deflate the economy, because at the inflation is basically the economy growing too fast, right? Effectively what it is, right? Like the cost of everything's going up, and which can kind of be a good thing, but actually if it goes too quick, it ends up being a bad thing. And so what we're trying to do is we're trying to deflate things. We're like, whoa, calm down, calm the farm, right? And the problem is, if we don't get it under wraps soon, then wages are going to rise to keep up with inflation, and then we start to go into an inflationary spiral, and it starts to get a bit out of control, right? So the aim of the game is for the RBA to try and effectively like hook on to the inflation rate. They want to be able to effectively match, right, the nominal interest rate with the inflation rate, all right? And so what they're trying to do is basically, okay, get to a point where we can find an equilibrium, right, with inflation, so that inflation, and at some point we'll find that equilibrium, because we're not finding it yet. So at the moment, what's happening is interest rates are going up, and they might go up so that the nominal interest rate, and we'll talk about nominal and real interest rates in a second, because I think it's a really interesting perspective to have, right? So the nominal interest rate may rise up to meet the current known inflation rate, but then if the inflation rate goes up again, and that means it hasn't caught on, hasn't got traction, hasn't found the equilibrium, right? And so we need to raise interest rates again and try and get that hook on, try and get a handle on inflation, because it's that's the anchor that we can use to pull inflation down. And at a certain point, like a set of scales, right, we're going to find that good balance, right? And then what will happen is inflation will start to dip off, right? And then we'll start to be able to release the grip of interest rates again. The other thing that happens, right, and that is, I will tell, I don't mind actually talking about my predictions and perspectives on the future, right? I think there's a couple of things that are almost 100% certain, right? Certainly in my mind. I am 100% certain that interest rates won't stay higher for longer than 2 years, right? We're talking probably end of 2023 or mid 2024, they'll start to come down. I'm very, very, very confident about that. And the reason for that is because all of this interest rate hiking, right, and the effort to effectively deflate the economy is going to cause a recession. Like, that's what happens. A recession is negative growth. And so what they're actually trying to do is actually cause, they're effectively trying to go for what they're calling a soft landing, where they can get inflation under control and somehow not cause us to go into negative growth. I mean,
land the plane swiftly.
Yeah. Talk about we talk about finding the Goldilocks zone, right? In real estate, talk about finding a Goldilocks zone, and I think that's a pretty. I mean, if they can do that, I'll be hats off to them. But I think it's highly unlikely. I think the much stronger likelihood is that we're going to go into recession. But again, these things don't last, right? These things won't last forever, right? And this is really important for people to understand, that all of this stuff is transitory. They're just moments in time in an ecosystem of wonderful things that we get to experience. And I think that people can get too emotional in the short term and forget about making decisions for the long term. So I'm very confident that none of this kind of stuff is going to last, and that we'll find that equilibrium in the next kind of like 12 months or so. But I think we've actually still got a fair way to go in terms of interest rates hiking up. But, and this is what we're going to talk about today, doesn't necessarily mean it's bad.
Are you taking a breath?
I'm taking a breath. What do you think, Gabi?
Far out, a lot in there. Yeah, so I think on that like transient piece, right? You and I understand that. And as you mature in your investment philosophies and understandings, you come to terms with that. And my hope with, a lot of what we do with our clients, but also like with this podcast and the education that we provide, is that it's helping everyone to have a different perspective, to think about things differently, and to be more steady in how they approach things and not reacting and freaking out, and being prepared, I guess, as well. Understanding that all of this is in some way, whatever we're in is some point of a cycle in whatever function, and it will pass. And so if you can understand that and be prepared for that when it comes, then when it arrives, you're like, cool, I knew this was coming, and I just need to play it like this now. And, however long it lasts, we'll just do this, and then it'll finish, and then we do something else. And I think this comes into play a lot with people who are not prepared for, interest rate rises and inflation and things. A lot of the concerns that come out of the market and from, most general people that don't think about investing is people aren't prepared. People have come out of COVID where, there was a lot of stimulus, and yes, we've got like huge amounts of household savings these days because people were getting a lot of, stimulus from the government, but then also not a huge opportunity to spend that. So there's a lot of savings that people have, but also we're not, the transition from that point to now this point where interest rates have gone up pretty significantly. It's a relatively short amount of time for such a societal kind of shift in behavior. So people are like, oh, I'm freaking out because the costs are more expensive.
Totally.
Yes.
But could I just jump in there and say that, like, in 2008, the fixed interest rate was 9%. Right, so we're not even vaguely in uncharted territories here. Like were people still investing in property in 2008? Yep, they sure were. Like back in March 1993, I think they were about 11%. You know, like if we go back, were people still investing in property successfully? Bloody oath they were, right? And so where people can kind of get a little bit waylaid is because the environment changes. They think that their process is completely out of whack, or they need to do something else. So in fact, they tend to do nothing, right? And they'll tend to stay in cash because, you know, if you look at the share market, I mean, you know, that hasn't exactly been going very well this year, has it? And now, is it on the rebound? Who knows? You know, has it found the bottom? Not sure. You know, like, so all of this kind of stuff causes people to kind of not do anything, right? And this is actually a really big issue, particularly in an inflationary environment. So now, headline inflation is about 6.1% at the moment, right? Roughly, but that's based on the latest measurement. But, you know,
on a variable.
No, inflation.
Inflation. Yep.
Yeah. So headline inflation is about 6.1%, right? So, but it's probably in reality, it's probably a little higher than that, right? So the problem with inflation is that it actually specifically and literally devalues the cash that you have in the bank, right? So let's just, for example, say that you've got $100,000 cash in the bank and you're sitting there thinking, should I invest in property or should I not invest in property? Interest rates are going up. Maybe I'll wait for interest rates to come down or do something like that. If we just for the point of the example, right, more than anything else, just say that inflation was 10%, right? Then over the course of 10% per annum, over the course of 12 months, you're actually going to lose 10% of your cash in terms of purchasing power, right? So what you can buy, let's just say in January 2022 versus December 2022, right? Again, this is just an example. When these are not actual figures that are existing right now, but more to paint the picture, right? Yeah. So let's say you had 100 grand on the 1st of January 2022, and then you don't spend it, and we have 10% inflation over the course of the year. That you're going to get to the end of December 2022, and your purchasing power is only going to be about $90,000. So what you could have bought for 100 grand back in January, you can't afford to buy now because you can only afford to buy 90 grand worth of stuff, right? And so that is the real and actual impact on inflation. It's effectively stealing your cash, right? It's no good, right? But where people kind of get a little bit waylaid is they go, oh yeah, but interest rates are going up, and you know, the cost of debt and all of that kind of stuff. But in fact, what's a really interesting discussion is what is the real interest rate, right? Because you have nominal interest rates, which are effectively the headline interest rates. So that's the kind of stuff you see from the banks, right? And the real interest rate is the nominal interest rate minus the inflation rate. And that actually gives you the real cost of capital, right? That actually tells you what the real cost of capital is. So for example, if the inflation rate was 10%, right? And the nominal interest rate, so that's the interest rate you pay to the bank, right, is 5%, right? And real inflation and real interest rates, are nominal interest rates minus the inflation rate. That would be 5% minus 10%. So you'd be at negative 5%, which in fact means that there's an arbitrage opportunity at play, right? If inflation is higher than nominal interest rates, or is growing faster than nominal interest rates, you have an opportunity to actually make money just by deploying that capital. Does that kind of make sense?
Yeah, it does. Yeah. I was just picturing this line, right? It's like you said earlier, like people think about inflation and most people don't think about it until it impacts them on a day-to-day basis. You go to the cafe and suddenly your coffee that used to cost $4 costs $5. That's extreme, but that kind of situation. And then you go,
it's not that extreme. I think it's like legit happening.
It's kind of relevant in the current environment.
Yeah. And we love coffee.
And we love coffee. So we're always comparing with coffee. But yeah, those kind of real life situations is when people that's when they wake up to it and they're like, oh, this inflation thing is real. And it's costing me more money. But people think about below that, people don't really think about it. But people do pay attention to interest rates and additional costs that they need to put out. So I'm thinking about this, if you think about a line and it's the costs that you have to spend out are above the line. So let's just say the average interest rate is 5.6 now at the moment.
Yep. Roughly.
Roughly. So it's like 5.6 above the line. But then inflation is this like silent cost that people don't think about, which is like your money is deflating, it is deroding if you leave it in cash by a certain amount. So if inflation is like 6.1, like roughly around today, that's like 6.1 below the line. So if you kind of measured them up, you would be like below the line still.
Yeah.
By
So
that
it's an interesting way to think about inflation, right? Because inflation on the one hand is dragging costs up. So people think inflation is the thing that makes things go up. But in fact, what inflation is doing is pushing down on your purchasing power, right?
Yeah.
So rather than it being like, everything's more expensive, it's actually, my money buys less, right? And so inflation is actually a corroding factor, right?
Yeah.
More than it is a price increasing factor. The only reason prices increase is because our purchasing power decreases effectively, right? So it's an interesting way to think about it in that above the line, below the line, because you've kind of got inflation, which is an anchor pulling down your purchasing power, right? And so in that example that you just gave, bearing in mind that, we're in a live environment. The RBA has literally, as we record this, just increased the cash rate. And so some of the figures we're using are completely general in nature, but it's to illustrate a point more than anything else. But if the inflation rate is 6.1%, and if the average mortgage is 5.6%, or the average mortgage rate is 5.6% interest rate, that's a nominal interest rate, 5.6 minus 6.1 equals minus 0.5%. So you've got a 0.5% arbitrage opportunity at play in your capital. So, and that is really interesting when you think about what the impact is on cash flow, right? Because your cash flow might go down. However, you might still, in theory at least, make up that difference in the combination of non-degraded purchasing power, right? In that arbitrage opportunity in that 0.5%, right? So let's say you lose $1,000 in cash flow, you might make up $2,000 in that arbitrage spread of 0.5%, which is pretty interesting as a way to think about it, right? Because if you're thinking about a total return basis, now that is not to discount the impact of degraded cash flows, right? And I want to do a whole episode just on that and how to think about that and what you can kind of do strategically to kind of navigate that. And that's really important in this current environment. But the point here is actually to look at what these different forces are doing, right? And how that might impact, right? So I'll just paint an example if that's all right, because it might actually help to kind of give us some color to it.
Yeah, sure. Cool? Yeah.
Okay. So for the point of this example, and it's extreme and it's deliberately because to try and show you the example. In the point of this, in this example, let's just say it's a 10% inflation, right? And a 5% interest rate, right? On your nominal interest rate. So if and let's just assume for the point of this, you're buying a $500,000 property and you're using 100% debt, right? Just for the picture. So let's say you borrow $500,000 and inflation is 10%. The purchasing power of that debt is being eroded by 10% a year. So if after 1 year, the $500,000 you borrow only has about $450,000 worth of purchasing power due to inflation, right? Because that's the rate at which your purchasing power is degrading thanks to inflation. So here's where it gets interesting. So right now, the inflation rate, generally speaking, is higher than the cost of debt, which is pretty fun. So if we use that example again, let's say you buy a house for $500,000, you borrow $500,000 from the bank with a 5% interest rate to purchase the property. The interest cost on that loan is going to be about $25,000. It's 5% of $500,000. So it's going to cost you about $25,000 in interest, right, on that property. If the inflation rate is 10%, then the purchasing power of the debt is being eroded, and the purchasing power of the debt is being eroded by $50,000 a year, right? That means the real interest rate is minus 5%, right? So 5% minus 10% is minus 5%. So that's negative, right? And so what that actually means is you're making $25,000 spread on the cost of the interest rate versus the degraded cost of capital, because it's costing you $25,000 in interest, but the purchasing power of the capital is degrading by $50,000. And by deploying that capital into a real asset, you're actually making a $25,000 spread, which is pretty interesting. Now, the actuality of the situation is not that extreme, right? So you're not making that much of a spread, but there is still an arbitrage opportunity at play there, or at the very least, an equilibrium at play there, where you're still actually, by deploying the capital, and using the opportunities at play here, using, getting access to capital, buying real assets, doing all of that kind of stuff versus keeping your cash in the bank, you're at least making up the opportunity cost. Because if you just had the money sitting in the bank, you'd be losing money. But at least by deploying it into a real asset, which is going to grow nominally in line with inflation, right? Then you're at least making up that arbitrage opportunity.
Yeah, and that's even just considering on a cash flow basis, right? It's like if you're deploying that into a real asset like real estate, you've got the capital growth element in there as well.
Yeah, totally, right. Yeah. So exactly. So all of this kind of stuff is really interesting to think about from a total return perspective, right? Because you mentioned this is on a cash flow basis. It's not purely on a cash flow basis because what we're talking about is purchasing nominal purchasing power, nominal interest rates, real interest rates, degradation, and so. But actually, when people need to think about what is the cost of capital, there's a hell of a lot more to it than just like what is my interest rate, right? Because the cost, like the cost of capital for any investor, and people need to really start thinking like institutional grade investors, right? And this is what anyone listening to this podcast effectively is. Like if you're building a property portfolio, you've effectively created your own personal REIT or fund or whatever. You're effectively, your own little Blackstone, and so what you really need to be thinking about is like, how do these people kind of think about things, and what is the real cost of capital, right? And the cost of capital is effectively determining the efficiency of the return of your money versus the cost of doing nothing, i.e. inflation, versus the cost of interest rates, and versus the total return that you still expect to get out of that asset, right? And so understanding that, you can really start to then look beyond purely just like the cost of my mortgage is going up, and actually start to think, okay, what is the real impact of inflation on my cash, but also, given inflation, what is the real impact of interest rates, or what in fact is the real interest rate? Because you might actually find, like, let's just say that interest rates on average go up to 6.1% and inflation stays at 6.1%. Well, if inflation is at 6.1% and the interest rates are at 6.1%, what is the real cost of capital? 0%, right? Because you're effectively arbitraging your point back to neutral, which is a bloody good place to be when the alternative is to have your cash degrade by 6.1%.
Yeah. And I guess with that, like, just the phrase like arbitrage, just for that to really make sense for people. So, like, I kind of think about it. It's kind of like an appeal for you to move, like, choose an investment vehicle over another option, in this case, leave it in cash, right? So it makes more financial sense. There is more appeal to invest in something because it is better than the original option, right? So it's almost like when you travel overseas to places like Bali, when you go to those places, like, you have your Australian income, and so comparatively, compared to the prices that you're used to spending in Australia, everything seems really cheap, right? So comparatively, and then you're more inclined to spend, and there's more velocity of money moving because the arbitrage opportunity, you're taking something that in your mind is worth $50 in Australia, but you can get it in Bali for $10. So you are more inclined to buy that, and probably a couple of times, they have that appeal. And that's that in like that inflationary environment, right? Whereas
that's geographic arbitrage.
That's geographic arbitrage, yeah. But you can imagine if you take that same situation, and instead of Bali prices being Bali prices, they're the exact same as Australian prices. Suddenly there's no appeal to be buying a lot of things in Bali because there's no opportunity there. So then people stop spending, and that's kind of how inflation comes back down.
Yeah, totally. Yeah, so arbitrage is really interesting, right? So in financial markets, like, it's more common for like in Forex trading or whatever, where the value of an Australian dollar in today's market in Australia versus the value of the pound, there might be an exchange rate difference of, a fraction of a percent or whatever. And you can trade those differences by trading currencies on different markets at different times of the day and just pick up the spread, right? That's kind of like, that's classic kind of financial arbitrage. I think you've got geographic arbitrage. And I was talking to one of our team members the other day. They used to live in Hong Kong, and they used to fly to Vietnam to get their suits made, right? Because in Hong Kong, the suits might cost them, thousands of dollars to get this really nice suit done, but he could fly to Ho Chi Minh City and get tailor-made custom suits made for like, a couple $100 and they'd be made in 24 hours and they'd be just as good a quality and whatever. And so he was, despite the cost of the flight, the cost of the accommodation, the cost of all of that kind of stuff, he was still ahead by about 50%. That's geographic arbitrage. You got time arbitrage, you got all these other kind of things, right? But really what the broader concept of it is like how to find the spread. Like, where is the spread? And how could you benefit from the spread, right? The spread between two price or value or cost inputs. How can you make the spread between those work for you, right? And that's really what it's all about. However you want to kind of shape it up and frame it up. And this is why I think it's quite interesting at the moment, is because if you're prepared to think independently about what is happening in the market versus just looking at headlines and get scared and all of that kind of stuff, right? Because what's happening in the market, in the real estate market, is not. If you listen to the media, it's not really happening. It's very interesting, right? Because the media is so Sydney centric. It is so crazily. In fact, I would go as far as to say everyone in Sydney is really Sydney centric. I've just been interviewing a bunch of candidates for a new role here at Dashdot, and it's so funny. If I ask someone who's not from Sydney, where are you from? Let's say they're from Adelaide. They'll say, I'm from Adelaide. They won't say what suburb they're in or whatever. They'll say, I'm from Adelaide. Oh, cool. If someone's from Sydney, and I say, where are you from? They'll say like Cherrybrook. I'm like, yeah, they'll specifically say the suburb, like it's the center of the universe and everyone needs to know exactly. I'm like, I don't know where Cherrybrook is. What is it? You're in Sydney, right? Got it. Cool. Thanks. Right. and it's quite interesting, right? Because you look at the media, and they're like, property prices are crashing, and it's like, well, on a market cap basis, lots of areas in Sydney are collapsing, right? And because of the cost of capital, a lot of the more expensive suburbs are declining a lot faster. I think they're 4 times faster is the last that I heard. The top end of the market is collapsing 4 times faster than any other market. That pulls down the averages, right? And so then there's a push to affordability and all of that kind of stuff, which is why that end of the market goes better, and et cetera, right? But then you get to look deeper into the markets as well, because there's also markets that we're currently buying properties in for our clients, where we're buying high quality assets we're purchasing them for less than the replacement value, right? Mm-hmm. That's arbitrage.
Yeah,
that's arbitrage. Okay, so I can pick this up for less than the cost it would take to build it. Okay, that's like okay, and that's factoring in any of the depreciation on the asset and all of that kind of stuff. So looking at these opportunities rather than focusing on single point metrics, just like cash flow, I think is actually the way to navigate this kind of an environment, right? And it's also critically important to be really thinking about what is the real cost of inflation, right? Because if you've just got your cash sitting in the bank, right, doing nothing, then the only thing that is happening to that cash is you're losing purchasing power, right? Versus deploying that capital. Now that does come with some other considerations, and it does come with some other costs and stuff like a mortgage, right? And maybe that's going to impact your cash flow and all that kind of stuff, right? But if you've got 100 grand sitting in the bank, right, and you're going to lose 10 grand in inflation, versus take that 100 grand, put it into a $500,000 property, on a 20%, on an 80% LVR, and maybe let's just say you go negative net cash flow by $1,000 or $2,000 or $3,000 a year, right? What's the spread? 7-8 grand, right? And so you're actually going to be better off, even though on the top line or on the bleeding edge, you're going to be going, this asset's no longer cash flow positive. It could be a bloody 6 or 7% yield. It could be a great asset, right? But because interest rates are temporarily high, and you may have a negative cash flow for a relatively short period of time, because you've got to remember rents are going up by between 12 and 20% in different locations. Crazy how fast rents are going up, right? So that'll be temporary, versus kind of like an absolute, you're losing your cash if you're leaving it in the bank, right? And so you've kind of got like one absolute outcome where you're going to be losing cash effectively by leaving it in the bank, or one where you can actually find the spread by deploying your capital in an effective and efficient way.
Yeah, again, coming back to that psychology piece, it's like if you are prepared and you understand that this is how it works, I can imagine a lot of people, reviewing their portfolios and, like you and I, we're slightly negative right now, which we've never had a portfolio that's slightly
I think by like
negative.
a couple of $100 a month or something, right? So
yeah. I don't think it's even that. I think it's like $100. But if you're not prepared for it and you don't have this education and this understanding that it's coming and how to think about it and not freak out about it, you can come into that situation and go, shit, we're cash flow positive now. That wasn't part of my strategy. Do I need to sell this property? Do I need to go and try and find a higher yield to make sure that I stay cash flow positive? And that's, again, it's like thinking that short-term thinking rather than thinking long-term, like, is this still a good asset for me? Is it still delivering what I need?
It's so interesting, right? Just to pick up on that point, right? So I think roughly speaking, don't quote me on this exactly, but roughly speaking, the assets in our portfolio have grown by about $150 a day, right? Like that's the return we've got. It's about $150 a day, right? Is the kind of return we've been getting out of our properties on average over the last however long we've owned them, which is pretty cool. And so we're making, let's call it $150 a day, right? And then let's just say one of those, let's say that's on one property, right? And so then let's say one property goes negative by $100 a month, right? It's cash flow negative. What do we do? And it's like, hang on a second, but it's making $150 a day every day for 30 days, and then it's going negative for $100 on one of those days. Would you throw that asset in the bin? And it's like, no, of course not. Would you give up something that's going to give you $150 a day? Right now, that is in equity and all of that kind of stuff. You can't spend equity at the shops and all of that. That all makes sense. But nonetheless, you've really got to look at what is the value that is being created versus purely just counting your dollars and cents that are in the bank. Now, of course, that's not to like come from a place of privilege or anything like that. Some people they can't afford $100 a month, and that's a real consideration too. So in that case, you've just got to assess your strategy and your life situation and all of that kind of stuff, and make the choices that are most appropriate for you. You could either potentially find it. We'll talk about that in another episode because I think there's some really good opportunities there, and it's really not to discount the impact that the interest rates can have on the day-to-day lives of individuals. We're not trying to do that at all. It's really just to try and reframe the opportunity that is right here, right now.
Yeah, I think on that as well. It's like, it doesn't matter what we suggest. At the end of the day, you are in your situation and you have your portfolio, and you just need to consider your situation, your current assets, your current income, your current cash available, and consider, what do I need to do? It doesn't matter like, oh, other people are doing this, and so-and-so Jimmy down the street said I should do this, and blah, blah, blah. It doesn't really matter what like the trends are. It's just you need to consider what is right for you. Even if like we're saying in this situation, it's probably financially from an investment perspective, makes more sense to put cash into investments from that real interest rate perspective, right? But if you're in a situation where you don't have much cash, don't take this as advice of like, okay, I've got to go and put it in a property. Like if that doesn't make sense for you, if you'd rather keep that cash because you feel more financially secure, having a cash buffer and all of that kind of stuff, then you do that, Part of this is just considering giving you some tools to think about so that you can sit there and contemplate what is right for me.
Yeah.
Rather than just kind of being blown around with like, oh, interest rates, okay, better go get cash flow and all this kind of stuff. So yeah, just like pausing and reflecting, and you are the only portfolio you need to think about.
Yeah, exactly. Run your own race at your own pace and forget about the rest. Comparison is the thief of joy, right? And the video's got a lot to answer for in my opinion. So I think we've covered a lot of ground on this episode. I do want to do another episode where we specifically target, okay, how do you deal with the cash flow component of rising interest rates? So we'll do that in a future episode. Why don't we leave it there for now, Gabi? What do you reckon?
Sounds great.
Awesome, guys. Let us know your feedback on this episode. If you thought it was useful, beneficial, did you get any kind of aha moments? Any feedback? I'd greatly appreciate it. Send it through to til@dashdot.com.au. And of course, if you want help to build a prolific, profitable property portfolio in the current environment, just reach out to us at dashdot.com.au/discovery. Grab a chat with the team, and we can help you out there. But until then, Have a great time, and we'll see you in the next episode.
See you.